In this video, I will explain the allowable business investment loss with the help of Mark's story. Mark is a successful businessman. He is not satisfied with the interest rate the bank is giving him and is looking for a higher rate of return on his investment. He remembers that one of his friends, Mary, runs a profitable spa business and needs financing to expand her operations. He calls Mary to discuss the investment opportunity. Mary shows him the projected profit and Mark finds the return on investment to be very attractive. So he decides to buy the share of Mary's small business corporation. Well, in the first year, business was good and Mark got a high amount of dividend from the spa business. Then in 2020, unfortunately, the business suffered lockdowns and by 2021, the business had gone bankrupt. This was a serious financial setback to both Mark and Mary. Mark could not get any money back from the business. At first, he was angry about the situation and then he became very sad about how things turned out. One of his friends told him that he could write off the shares, but Mark was unsure how he could do that. He searched the internet and found complex legislation regarding the loss write-off and eventually decided to hire a chartered professional accountant to help him out. The CPA explained that this loss was a business investment loss, a specific type of loss that will occur when he sells or gets rid of the shares in the small business corporation, or when a debt is owed to him by a small business corporation. This loss is also commonly referred to as Allowable Business Investment Loss, or ABIL in short form. The CPA helped him to do the filing with the Canada Revenue Agency to have deemed disposition of the debt or shares. Mark questioned back the CPA as to how he was deemed to have disposed of the property when no actual sales of the shares has taken place. The CPA explained that a deemed disposition is a term used when an individual is considered to have disposed of a property even though no actual sale has taken place, meaning it is for nil proceeds. The CPA filed the necessary paperwork with the CRA and then elected to dispose of the shares or debt for zero proceeds and claimed the loss as the amount of his investment or the amounts that are owing. Mark saved a lot of money in tax by using this tax strategy. Mark could deduct half of the investment business loss from his income. The actual amount of the loss deducted was Mark's allowable business investment loss. Now you may ask, what if Mark's allowable business loss was more than his income in the year? Well, he could have included the additional amount as part of his non-capital losses for the year. Well, non-capital losses can be carried forward up to 10 years and carried back up to 3 years. Moreover, by carrying the loss back to prior years, he could adjust his past tax returns and reduced income from those years using a Form T1A request for loss carryback. So friends, please remember to talk to your chartered professional accountant because claims for ABIL must include a thorough note to CRA that can be sent along with your tax return. The note should declare the name of the small business corporation, the name and class of shares or type of debt disposed of, the date of either insolvency, bankruptcy or wind up, and the date when you purchase the shares or debt, the proceeds on disposition, the cost base, any expenses incurred on the disposition, and the actual amount of loss. Well, complexities regarding the allowable business loss claims do occur, but if you prepare in advance and take the advice of your chartered professional accountant to structure the claim properly, the claim will be more routine and successful with CRA. Thanks for watching this video and see you in my next video. If you want to be notified about my new tax updates, please consider subscribing to my YouTube channel. Thank you.